Welcome to the Explainer. Okay, listen up because a massive regulatory earthquake is about to hit the global banking world, and trust me, it is going to directly impact your wallet. We're talking about a fundamental, ground-up shift in how financial institutions assess risk, how they manage your loans, and ultimately, how much they are going to charge you just to borrow money. It's a massive systemic overhaul dropping on April 1st, 2027. So today, we're breaking down this shockwave, and we'll look at the powerful technological engines running behind the scenes right now to prepare for it. Let's get right into it. Right off the bat, I need you to focus on this number, 12.5. This is the hook for everything we're discussing today. Starting in April 2027, just a single slip in your credit profile could act as a 12.5x cost multiplier for the bank holding your loan. Let that sink in. That is an absolutely massive spike in operational costs for them. And as we're going to see, it's a cost that will inevitably be passed straight down to you. But to really grasp why this huge spike happens, we've got to look at how the banking rules themselves are fundamentally changing. Okay, let's dive into this. Until now, banks have basically operated on a backward-looking model. They only set aside safety capital, or what they call provisioning, for losses they could physically see after a loan already defaulted. Basically, a loan went bad, the bank booked the loss, and they reacted. But the new 2027 central banking framework flips this completely on its head. Banks must now provision for expected future losses. Literally, they have to set aside money for defaults that haven't even happened yet, but that they mathematically anticipate might happen. It's a huge pivot from being reactive to being entirely predictive. Section 1. Expected Credit Loss Explained. So this new predictive model is officially called the Expected Credit Loss Framework, or ECL for short. And it literally forces banks to categorize every single borrower into a super strict hierarchy of risk right from day one. Stage 1, that's your healthy borrower. For them, banks only need to provision a tiny 0.40% of the loan amount. But check out Stage 2. If your risk profile increases even slightly, boom, you drop to Stage 2, and the bank must instantly provision up to 5%. Jumping from 0.40 to 5%, that is exactly the 12.5x jump in costs we just talked about. And finally, there's Stage 3. That's for fully credit-impaired loans, requiring the bank to provision for the entire lifetime expected loss of that asset. Now, what's really interesting about this is how exactly the banks calculate these expected losses. The math actually runs on three critical parameters. First, you have PD, or probability of default. Basically, what are the mathematical odds that you're going to miss a payment? Second is LGD, loss given default. If you actually do miss it, how much money does the bank really lose? And third is EAD, exposure at default. Meaning, what is the total balance at risk when it happens? These three variables together are going to act as the strict new risk math governing your financial life. So what does this all mean in plain English? Well, because banks are now legally required to predict risk before it happens using all these complex formulas, they are effectively forced to adopt an insurance-like mindset. Think about it. An insurance company prices your policy based on the mathematical probability of you crashing your car or getting sick, right? Well, come 2027, banks are going to price your loans based on the exact mathematical probability of you missing a monthly payment. They absolutely must protect their portfolios preemptively. And that brings us to the million-dollar question. Who pays for that massive 12.5x jump in back-end provisioning costs? You guessed it. You do. Now, credit bureaus typically treat a score of 731 and above as prime, and 730 or below as below prime. If you're sitting at 730 or below, mathematically, you represent a higher statistical probability of default. So under the new 2027 rules, that literally means you are going to face significantly higher interest rates and way stricter approvals on everything. Credit cards, personal loans, home loans, the whole shebang. Section 2, the engine, modern lending systems. To actually calculate these expected losses for millions of customers in real time, banks rely on some incredibly robust, highly automated software ecosystems. And today, this whole lending ecosystem is cleanly divided into two major technological halves. First up is the loan origination system, or LOS. This handles everything pre-disbursement, onboarding you, gathering your documents, underwriting the risk, and approving the loan. The second half is the loan management system, or LMS. This kicks in post-disbursement and handles the rest of the life cycle, scheduling your payments, tracking collections, and eventually closing the loan out. Section 3, Phase 1, Loan Origination. So origination is essentially the starting line. The main goal here is securely capturing the borrower and assessing their risk profile before a single dollar is ever handed out. And for a modern borrower, this journey is completely digital and, honestly, practically frictionless. It kicks off with lead capture and a digital application.
Then it flows right into underwriting and bureau assessment, where the system instantly pulls your credit data. Finally, it moves to sanction and disbursement. What feels like just a couple of quick taps on your smartphone is actually a massive digital backbone seamlessly connecting sales, legal, technical, operations, and finance teams all into one integrated flow.
And you know what's crazy? This backbone is increasingly powered entirely by artificial intelligence. By bringing in AI lead scoring, automated eligibility engines, OCR-based document processing, and smart underwriting, banks are actively minimizing their operational risk. They're basically taking those slow, error-prone manual human checks and replacing them with lightning-fast smart data streams. For you and me, this means higher straight-through processing and way, way faster turnaround times.
Section 4, Phase 2, Loan Management.
Let's move to phase 2 and see how this builds, because most people think the journey is over the second the money hits their bank account. But in this new era of expected credit loss, post-disbursement is where the real intense risk monitoring begins. The loan management system serves as the ultimate bird's-eye view dashboard for the bank's entire portfolio. It's managing the continuous life cycle, generating your payment schedule, setting up auto debits, meticulously tracking every single repayment, and instantly flagging any delinquencies. The very moment a payment is missed, the system screams at the bank, potentially shoving your loan straight into that incredibly costly Stage 2 category we talked about earlier. And to pull this off flawlessly, the LMS has to rely on a massive back-end web of enterprise integrations. I mean, it is constantly talking to the core banking systems, it's pinging payment gateways, syncing with notification platforms to shoot you those text reminders, and managing documents. This massive interconnected web is absolutely crucial to ensure regulatory compliance and to automate collections before a simple mispayment snowballs into a full-blown default.
This whole dynamic brilliantly highlights a really vital insight from the industry. Basically, loan disbursement is not the end of the lending journey. It is the beginning of a long-term customer relationship. And it is a relationship that literally doesn't end until the loan is fully paid off. Under the upcoming 2027 rules, the true test of a bank's risk management happens precisely right here in the ongoing day-to-day servicing of the loan.
Section 5. Protecting your credit profile. So, the big question. How do you actually protect your wallet and your borrowing power from these super unforgiving macroeconomic systems? Well, you need to take these 4 critical defensive actions right now. First, pay every single installment on time. Seriously, a single slip triggers system alarms. Second, keep your credit card utilization under 30%. That shows the algorithm you aren't desperate for funds. Third, avoid unnecessary credit inquiries, because those will instantly ding your score. And fourth, check your credit report every 6 months to make sure there are no errors dragging you down. Remember, under the new expected credit loss framework, even a minor drop in your profile can trigger those severe Stage 2 penalties and hike up your future interest rates. Look, the banks are upgrading their systems as we speak. They're integrating AI, and they are preparing to predict your financial failures before they even happen, just to protect their bottom line. The systems are getting vastly smarter and a whole lot more unforgiving. So I leave you with this one critical question to think about. The systems are getting smarter. Is your credit profile ready for 2027? Take control of your financial habits today, because the rules of the game are changing forever. Thanks so much for joining this explainer, and I'll catch you next time.